I'm going to tell you where the money goes when you buy a stock, and spoiler alert, it's not into the company's bank account. I'm also going to tell you how stock prices are determined on a moment-to-moment basis, as well as we're going to cover what an IPO is and what happens when a company issues new shares. So let's get right into it. Hey everyone, I'm Richard Hopkins and welcome to another video. If you're new here and you want to learn how to invest in stocks successfully and reach financial freedom sooner, then start now by hitting subscribe and ringing that bell so you don't miss anything. If tomorrow morning I woke up and I bought $1,000 worth of Apple stock, that $1,000 does not somehow wind up in Apple's bank account. Here's how it actually works. When you buy shares, you're buying them from someone else who owns those shares and is making the decision to sell them. A lot of people seem to have this idea in their head that when you buy shares, you're somehow giving money to the company, but that's just not how it works. Having said that, if you stay to the end of this video, I am going to tell you one scenario where the money used to buy shares does actually go directly into the hands of the company. So let's get into it. The buying and selling of shares takes place between two parties. One who wants to buy and own those shares, and the other who already owns them and wants to sell them. This trading of stock shares is facilitated by the stock market. Similar to how your local Saturday morning farmers market is a place where one can go to buy and sell produce and other foods, the stock market is a place where one can buy and sell ownership stakes in companies. I say ownership stakes in companies because that's exactly what stocks are. These days it's all digital and you can do it all from an app on your phone. But back in the day, like how the farmers market is an actual physical location, so was the stock market. Not just anyone was allowed on the trading floor back then, however. So if you wanted to buy stocks, you needed a stock broker who you'd call up and you'd place your buy and sell orders with them, and they would get passed through to the brokerage's trader on the trading floor. These days though, like I said, you can do it all from an app on your phone. And there are plenty of online brokerages to choose from. Personally, I like interactive brokers. Now, when you look at a stock quote on your phone, you're going to see a bid price and an ask price. Listen, because this is an important principle. The bid price is the highest price a buyer is willing to buy shares for at any given moment. And the ask price is the lowest price a seller is willing to sell their shares for at any given moment. The bid and ask prices are based on current, real-time, open orders in the market. And the quoted price of a stock is just whatever the price the last buy or sell transaction was for. Let me say that last part in another way because it's important. Stock prices are based on whatever price it last traded for. So if there's more buyers than sellers, then prices will tend to gravitate higher, and vice versa. For successful investors, by the way, what everyone else is doing is not important. So although some stock buyers and sellers are making their decisions based on what everyone else is doing, successful investors are independent thinkers. They start by first valuing the company and then looking at the price it's trading for, and they make an independent decision. So a video called "Where Does the Money Go When You Buy a Stock" would not be complete without me telling you first about IPOs, as well as what happens when a company decides to issue new shares. IPO is an acronym for Initial Public Offering. Before any public company becomes a public company, it was once a private company. Why would a private company want to go public? Well, the goal for a company when going public is to raise money, usually to continue to grow and expand. Typically how the IPO process works is a company that has decided to go public will hire an investment bank who will handle the sale of the new shares. Together, they will determine the valuation, the number of new shares, and the price per share. In most cases, particularly if the investment bank feels that it's going to be a successful IPO, that investment bank will buy all of the shares and then sell them through a syndicate of other banks and brokers. For you as the investor, occasionally the bank that your brokerage account is held may be one of the banks that are participating in this selling group and may offer you the opportunity to buy those shares before the IPO date. But for the most part, you'll need to wait till the IPO date when the shares become public and can be traded on the stock market. And at this time, same as usual, you'll be buying those shares from someone else who owns them, whether that's one of the banks participating in the selling group or another investor just like yourself who already bought the shares before you and is already making the decision to sell them. Warren Buffett, by the way, does not suggest buying IPOs, and he does not suggest the average investor does either. The reason for this is usually companies will decide to IPO at the exact moment they're going to be able to get the highest valuation possible. which means that although it could be possible for you to purchase IPO shares at a good price, more than likely you're going to be significantly overpaying. Buffett's take on it is this: it's almost a mathematical impossibility to imagine that out of the thousands of things for sale on a given day, the most attractively priced is the one being sold by a knowledgeable seller, company insiders, to a less knowledgeable buyer, investors. Let me know in the comments below if you've ever purchased an IPO stock and how that worked out for you, or how is it working out for you so far. And also, don't forget to like this video for the YouTube algorithm because it really helps out. So, moving on from the IPO discussion now I'm going to tell you what happens when a company decides to issue new shares. Sometimes companies may decide to issue new shares as a way of raising money. This can happen at any stage in a company's lifespan when they want to raise money without taking on more debt. Sometimes this can be done as an underwritten deal, similar to how IPOs work, where the investment bank buys all the new shares and then sells them through a syndicate of other banks and brokers. Another way is a company may do a rights issue to its existing shareholders, which gives them the right to buy the new shares first, sometimes even at a discounted price. This scenario is one where the money you use to purchase those shares would go directly into the hands of the company to be used by the CEO however he saw fit. Now, this next thing I'm going to tell you right now is getting a little into the advanced level, but it is worth mentioning right now while I'm talking about new share issuing. If a company that you own issues new shares, two things are going to happen. First, because the total number of shares outstanding has increased while the number of shares that you own has remained the same, your ownership percentage of that company has decreased. For example, if a company has 1 million shares outstanding and you own 1,000 of them, you would own 0.001% of that company. If the company issues 200,000 new shares, the total shares outstanding would become 1,200,000. But since you still own just 1,000 shares, it means that you would now own 0.0008% of that company. This is called stock dilution. Typically, this is not great for you as a shareholder. The second thing that will happen though is that the cash on the company's balance sheet will increase by the amount of new money that's been raised. So, back to the example that we just used, if those original 1 million shares outstanding were priced at $10 per share, this means that the market cap of the company is 10 million. If the company issues 200,000 new shares at the $10 per share price, it will have raised $2 million. This $2 million would go into the bank account of that company, which should increase its value by $2 million as well. The $10 million company that now has an extra $2 million of cash should be valued at $12 million. And because the total number of shares outstanding is now 1,200,000, the price per share is unchanged, still at $10 per share. Although on paper, from one perspective, it could look like it just cancels itself out and it's not that big of a deal, in reality, share dilution is usually bad for shareholders because it means that you're owning less of the company. However, there's not a one-size-fits-all answer here because it's not always bad either. But that is a topic for another video. Let me know in the comments below what you thought of this video, and let me know your questions as well. And if you haven't already liked this video, please like this video right now. And if you're not a subscriber yet, do that now and also ring the bell at the same time. And if you want to keep expanding your stock investing knowledge right now, I've made another great video for you right over here to watch next. So click here right now and I'll see you over there.